Okay, so you want to own a beauty salon, chairs facing mirrors down, a bright, stylish room, the hum of blow dryers, a loyal clientele who won't let anyone else touch their hair, a business built entirely around genuine personal relationships and real craft. You picture yourself as the owner of a place people actually look forward to visiting, collecting steady revenue from services people need on a recurring basis, whether the economy is good or bad. That's the fantasy. Here's the actual business hiding underneath it. An industry where the single biggest strategic decision an owner makes isn't about location or decor. It's about whether the stylists working in your chairs are actually your employees at all. A decision that fundamentally reshapes the entire legal and financial structure of the business. And an industry where a salon's real, durable value frequently isn't the lease or the equipment. It's a set of personal relationships between individual stylists and their clients that can, and regularly does, simply walk out the door and set up shop across the street. Some salon owners have built genuinely valuable, multi-chair, multi-location businesses worth real money. Others have discovered, sometimes years into ownership, that they were never actually building an asset at all. They were building a stage for other people's independent businesses to perform on. By the end of this, you'll understand exactly why the booth rental model that dominates a huge share of this industry represents one of the strangest ownership structures in this entire series. A business where the owner frequently doesn't control the labor, doesn't own the client relationships, and still has to cover essentially all of the fixed costs, regardless what you're actually buying before the money makes sense. You need to understand that owning a salon today describes two genuinely different business models, and the distinction between them explains almost everything else about this industry's economics. The first, and historically the traditional model, is the commission or employee model, where stylists are genuine employees of the salon, earning a percentage commission on the services they perform, sometimes supplemented with hourly wages, in exchange for which the salon owner retains full control over pricing, scheduling, service standards, and, critically, the client relationship itself. Since client contact information, appointment history, and the salon's own booking system belong to the business rather than to the individual stylist. The second, and increasingly dominant model across large parts of this industry, is the booth rental or chair rental model, where individual stylists are genuinely independent contractors who pay the salon owner a fixed weekly or monthly rent for the use of a chair, a station, and the shared facility, but who set their own prices, their own hours, and critically, own their own client relationships entirely, meaning the salon owner's actual revenue in this model isn't tied to how many haircuts get performed or how much those haircuts cost. It's simply the rent roll collected from. However, many booths are currently occupied, a structure that, according to industry analysis from organizations tracking salon business models, has become the dominant arrangement across a substantial share of the American hair salon industry. Specifically, driven largely by its appeal to skilled stylists who can earn considerably more running their own book of business independently than they could on a traditional commission structure, while simultaneously appealing to salon owners who trade away service revenue upside for the predictability and reduced management burden of a pure real estate rental model. Understanding which of these two models, or increasingly, a hybrid combining both within the same location, a given salon operates under explains an enormous share of that salon's actual risk profile, its growth potential, and critically, what the owner actually owns if they ever wanted to sell the business. The booth rental trade often understand why so many salon owners have moved toward the booth rental model, despite its obvious limitations. You have to understand the specific trade-off it represents, because it fundamentally exchanges upside for predictability in a way that's worth examining closely. Under the booth rental model, according to industry data on typical rental structures, individual stylists commonly pay somewhere in the range of $150 to $400 per week per station, depending on market and location. Prestige, a fixed, predictable revenue stream for the salon owner that arrives regardless of how busy that specific stylist's book happens to be in a given week. meaning the salon owner's own revenue volatility is dramatically reduced compared to a commission model where revenue rises and falls directly with actual service volume and pricing across the whole team. This predictability comes at a genuine cost, however, since the salon owner in a pure booth rental structure captures none of the upside when a particularly talented, in-demand stylist builds an exceptionally strong book of business and could command premium service pricing. That additional value accrues entirely to the independent stylist rather than flowing through to the owner the way it would under a commission structure, meaning a booth rental salon's revenue ceiling is fundamentally capped by the number of stations times the rental rate, with no meaningful additional upside, no matter how successful the individual stylists become. The legal and tax classification distinction between these models carries genuinely significant ongoing compliance risk that has become an increasingly scrutinized area for state labor regulators, since correctly classifying a stylist as a genuine independent contractor requires that they actually operate with the independence the classification implies, setting their own hours, their own prices, using their own supplies in some structures, rather than functioning as a de facto employee who simply happens to be labeled a contractor for tax and liability convenience, and salon owners who blur this line, requiring booth renters to work specific hours, use only salon-provided products, or follow specific service protocols the way an actual employee would, have faced genuine legal exposure and back tax liability. In states that have increasingly scrutinized worker misclassification, specifically within the personal care services industry, the cost of actually building the thing opening a salon requires a meaningfully different capital investment depending on scale and service mix. And understanding the specific cost structure explains why this industry includes both genuinely modest, low-barrier small businesses and considerably more capital-intensive full-service operations. According to industry cost data tracked by beauty industry trade publications and small business lending sources, opening a modest, single suite or small storefront hair salon commonly requires $50,000 to $150,000 in total startup investment, covering leasehold improvements, styling chairs and stations, shampoo bowls, and the specific plumbing and electrical work a salon's water and equipment needs require beyond a standard retail build-out. A larger, full-service salon offering hair, nail, aesthetics, and spa services simultaneously represents a considerably larger investment, commonly $200,000 to $500,000 or more, given the additional specialized equipment, private treatment rooms, and considerably larger physical footprint. A genuinely full-service operation requires to accommodate multiple service categories operating simultaneously. Plumbing and electrical infrastructure deserve specific attention as a cost category that genuinely surprises first-time salon owners coming from other retail backgrounds, since every styling station requires a functioning shampoo bowl with hot water access, and a full-service salon's water heater and plumbing capacity has to be sized to handle multiple simultaneous shampoo services throughout a busy day, a specific commercial plumbing requirement that can add tens of thousands of dollars to a build-out that might otherwise look like a straightforward retail renovation. Licensing represents a genuinely significant, ongoing compliance category specific to this industry, since cosmetology and barbering are licensed professions in every U.S. state, meaning both the salon as a business entity and every individual stylist working within it, whether employee or booth renter, maintain current state cosmetology licensure, and salon owners bear meaningful liability exposure if they knowingly allow an unlicensed individual to perform services, or if their facility fails a state board health and sanitation inspection. A regulatory compliance burden that adds both direct licensing costs and genuine ongoing operational discipline requirements around health and safety protocols that many other small retail businesses examined throughout this series don't face to the same degree. The bill that never stops running a salon involves ongoing costs that vary considerably depending on which ownership model a given location operates under. But several categories remain genuinely unavoidable, regardless of structure. Rent represents the dominant fixed cost for most salon owners, and salons typically require prominent, accessible retail or strip mall locations with adequate parking, meaning lease costs track closely with the broader commercial retail real estate market in a given area. A cost that, under the booth rental model specifically, the owner has to cover in full through rental income, regardless of how many stations happen to be occupied in a given month, creating genuine exposure if stylist turnover leaves several stations vacant simultaneously. Product and supply costs represent a meaningful ongoing category that varies considerably by ownership model. Since a commission-based salon typically purchases professional product inventory, the shampoos, colors, and styling products used during services, as a direct cost of the business, while under a pure booth rental model, individual stylists frequently purchase and supply their own product inventory, shifting this specific cost away from the salon owner entirely. Though many salons maintain a retail product line sold directly to clients as a separate, genuinely high-margin revenue category, regardless of which service model the salon otherwise operates under, utilities represent a genuinely significant, salon-specific cost category given the water heating demands already discussed, along with the electricity required to run multiple hair dryers, styling tools, and often specialized equipment like hooded dryers or nail service ventilation systems simultaneously throughout a busy operating day. A utility cost profile that runs meaningfully higher per square foot than a comparable retail space without this same equipment-intensive service delivery. Insurance represents a distinctive, genuinely necessary cost category specific to this industry, since salons carry meaningful liability exposure around chemical services, hair coloring treatments, chemical relaxers, and other services involving products that can cause genuine physical harm if improperly applied or if a client has an undisclosed allergic reaction, meaning professional liability insurance represents a real, ongoing cost that scales with the specific service mix a salon offers, with chemical service-heavy salons generally carrying meaningfully higher premiums than salons focused primarily on cutting and styling services with lower inherent chemical exposure risk. How the money actually comes back. Revenue models across the commission and booth rental structures reveal genuinely different underlying economics that determine what actually drives a salon's profitability. In a commission-based salon, according to industry benchmarking data, stylists commonly earn somewhere in the range of 40 to 60% of the service revenue they personally generate, meaning the salon retains the remaining share to cover overhead, product costs, and owner profit. A structure where the salon's total revenue and profitability scale directly with how effectively the owner manages stylist scheduling, retail product sales, and overall service pricing across the entire team, giving the owner genuine, direct financial incentive to invest in marketing, training, and client retention initiatives that grow the whole salon's business, since that growth flows directly to the owner's own bottom line. In a booth rental salon, by contrast, the owner's revenue is essentially fixed regardless of how busy individual stylists are, meaning the owner's primary financial lever isn't growing service revenue at all. It's maintaining full station occupancy and, where market conditions allow, gradually increasing the rental rate charged per station, a fundamentally different, more purely real estate-oriented business model where the owner's operational focus shifts toward stylist recruitment and retention as tenants rather than toward growing the underlying service business itself. Retail product sales represent a genuinely significant, high-margin revenue category available to salon owners under either model, since professional hair and beauty products sold directly to clients following an in-salon consultation typically carry considerably higher margins than the service revenue itself, and salons that successfully build genuine retail sales culture among their stylists, whether employees incentivized through commission on retail sales or booth renters who've agreed to participate in the salon's retail program, can meaningfully supplement their overall profitability through this channel, regardless of which core service model the salon otherwise operates under. Membership and subscription models, where clients pay a recurring monthly fee in exchange for discounted or included services, have become an increasingly significant revenue innovation across parts of this industry over the past decade, particularly in the blow-dry bar and quick-service hair category, providing salon owners with the kind of predictable, recurring revenue stream that smooths out the inherent week-to-week variability of a purely transactional, walk-in and appointment-driven, traditional salon business model. The volatility nobody wants to talk about behind the structural ownership model risks already discussed. Salon ownership carries several other distinctive, ongoing risks. Stylist turnover and client portability represents perhaps the single most consequential and most genuinely underappreciated risk specific to this industry, since a salon's actual client relationships frequently belong more to the individual stylist who performs the service than to the business itself, meaning a popular and demand stylist leaving for a competing salon, or simply opening their own independent operation, can take a substantial share of the salon's actual client base and revenue with them essentially overnight, a risk that exists under both ownership models, but that becomes an explicit, legally protected reality under the booth rental structure, specifically, where the stylist genuinely owns those client relationships as a matter of established business and legal practice. Non-compete and client non-solicitation agreements, while common in salon employment contracts, have become increasingly difficult to enforce in many states, as a broader legal and regulatory trend against restrictive employment covenants has specifically targeted the kind of non-compete clauses that salon owners have historically relied on to protect against exactly the stylist departure risk, meaning the legal protection salon owners once counted on to prevent a departing stylist from immediately soliciting their former clients has genuinely weakened in many jurisdictions over the past several years. Consumer discretionary spending sensitivity affects different service categories within this industry quite differently, since basic hair maintenance, haircuts, and root touch-ups, specifically, tends to remain relatively insulated from broader economic downturns, given how directly tied these services are to genuine personal grooming necessity rather than pure discretionary indulgence. While higher-end spa services, elaborate color treatments, and nail art represent considerably more genuinely discretionary spending that clients defer more readily during periods of economic uncertainty, meaning a salon-specific service mix meaningfully determines how insulated or exposed its revenue is to broader economic cycles. And licensing and regulatory compliance risk represents an ongoing operational vulnerability specific to this heavily regulated personal care industry, since a single significant health code violation, an improperly sanitized tool causing a client infection, or a serious chemical service reaction, can trigger not just direct liability exposure, but genuine reputational damage. In an industry where word of mouth and online review reputation carries outsized importance relative to a client's typically low consideration, habit-driven decision about where to get a routine haircut, the real case study, the rise of the suite rental model, and Sola Salon Studios understand how dramatically the underlying structure of this industry has shifted over the past 2 decades. Look at the rise of the salon suite model exemplified by companies like Sola Salon Studios, a business model that has taken the booth rental concept and restructured it entirely around individual, fully private, lockable studio spaces rather than open stations within a shared salon floor. Under this model, the suite operator, functioning essentially as a specialized commercial landlord rather than a traditional salon owner at all, leases individual private studios to independent beauty professionals, stylists, estheticians, nail technicians, and other personal care providers who then operate their own genuinely independent businesses entirely within their own private space, setting their own hours, their own pricing, their own branding, and their own client relationships with none of the shared floor dynamics or centralized service standards that even a traditional booth rental salon typically maintains. According to the company's own public descriptions of its business model and industry reporting on the specific segment's rapid growth, This suite rental model has expanded to hundreds of locations across North America over the roughly 15 years since the concept gained meaningful traction, representing a genuinely significant structural evolution beyond even the traditional booth rental model discussed earlier. Since the suite operator's business is now explicitly and entirely a real estate leasing operation, collecting predictable rental income from individual beauty professional tenants with essentially zero involvement in or financial exposure to the actual underlying service business those tenants operate. A complete structural inversion from the traditional salon ownership model, where the owner's fortunes were directly tied to the collective service revenue generated under their roof. This suite rental model's rapid growth illustrates a genuinely important structural lesson specific to this industry's recent evolution, faced with the persistent challenge of stylist turnover, client portability, and the genuine difficulty of building durable, transferable business value around a workforce whose core professional relationships legally and practically belong to the individual practitioner rather than the business. A meaningful and growing segment of this industry has responded not by trying to solve that structural challenge through better retention strategies or more restrictive contracts, but by essentially abandoning the traditional salon ownership model altogether in favor of a considerably simpler, more purely real estate-oriented business that sidesteps the underlying tension entirely, accepting a lower revenue ceiling per square foot in exchange for a genuinely more predictable, lower management intensity business model that doesn't depend on successfully managing the fundamentally difficult, relationship-dependent dynamics that have made traditional full-service salon ownership such a genuinely challenging business to scale and sustain. Two scenarios. Let's build the honest math, the way an actual owner has to run it. In the good scenario, you own a well-run, commission-based salon in a strong local market, with a stable, loyal team of stylists who've built genuine tenure and mutual investment in the salon's collective success. Supported by a compensation structure and salon culture, ongoing training, a genuinely positive working environment, meaningful retail sales incentives that gives your stylists real reasons to stay and grow their business within your salon, rather than viewing your location as merely a stepping stone to eventual independence. Your salon has built genuine brand reputation beyond any single stylist's individual following, driven by consistent service quality, a strong retail product program, and marketing that promotes the salon itself rather than only individual practitioners. Meaning in when turnover inevitably occurs, your business retains meaningful client relationships and revenue rather than losing everything a departing stylist personally serviced. In a genuinely well-run commission salon like this, owners can capture meaningful upside from their team's collective success, growing revenue and profitability as the salon's overall reputation and client base expand. A business that, done well, can generate genuinely attractive returns while also building real, transferable enterprise value that would command a meaningful sale price to a future buyer precisely because that value is embedded in the business's systems, reputation, and diversified client relationships rather than in any single individual's personal book of business. Now, the harder scenario. You own a booth rental salon where several of your most successful, longest tenured stylists, the ones generating the strongest individual books of business and the steadiest rental income, simultaneously decide to leave for a newly opened suite rental facility nearby, offering more privacy and complete independence. A genuine risk, given how little structural loyalty the booth rental model itself creates between stylist and salon beyond the specific convenience of that particular location. Your rental income drops immediately and substantially as those stations sit vacant. During the search for replacement renters, a search complicated by the reality that skilled, established stylists with existing client books are precisely the renters least likely to need to switch locations, meaning you're frequently left competing for newer, less established stylists still building their own client base, who generate less reliable rental income and represent a higher ongoing turnover risk themselves as they eventually build enough of a following to command better terms elsewhere. The gap between these two scenarios isn't a modest variance in a leasing forecast. It's the difference between a genuine, growing, sellable business asset and a real estate operation permanently vulnerable to the specific individuals currently occupying your stations, with essentially no way to build the kind of durable, business-level value that would exist independent of whichever specific stylists happen to be renting from you in any given month. The real payoff: the difference between salon owners who build genuine, lasting business value and those who end up running what amounts to a vulnerable, relationship-dependent real estate operation comes down to understanding, with genuine clarity, which of these fundamentally different business models you're actually building, and structuring your entire strategy, your compensation approach, your marketing, your culture, around that specific model's genuine strengths, rather than trying to capture the benefits of both simultaneously. Building genuine salon-level brand equity and client relationships that exist independent of any single stylist, through consistent service standards, meaningful retail programs, and marketing that promotes the business itself rather than exclusively elevating individual practitioners, matters enormously for owners pursuing the commission model specifically, since this is precisely the differentiator that allows a commission salon to retain real value through inevitable stylist turnover in a way a pure booth rental operation structurally cannot. Understanding, with genuine honesty, that the booth rental and suite rental models represent a deliberate trade of growth potential and enterprise value for operational predictability and reduced management burden, rather than viewing them as simply an easier version of the same underlying business, allows an owner to build realistic expectations and financial planning around what that specific model can and cannot deliver. Since chasing commission model style growth ambitions while operating a booth rental structure represents a genuine strategic mismatch that has disappointed more than one salon owner who didn't fully internalize which business they'd actually built, and maintaining genuine, proactive attention to compliance around worker classification, licensing, and the specific health and safety protocols this heavily regulated industry demands protects against the kind of legal and reputational risk that can undermine years of otherwise careful, disciplined business building in a single serious incident or regulatory finding. The romance of the salon, the genuine craft, the real relationships built between stylists and the clients who trust them with something as personal as their own appearance, is entirely real, and it's precisely the owners who've built their specific business model with genuine clarity about what they actually own, the service business itself, or simply the real estate underneath it, who have built something that survives and grows, rather than discovering, sometimes painfully, that the value they assumed they were building had legally and practically belonged to someone else the entire time. Which means the honest answer to whether owning a salon can build genuine, lasting wealth is yes, for owners disciplined enough to choose one model deliberately and build toward its actual strengths. But the industry's own structural evolution toward booth and suite rental over the past 2 decades stands as a genuinely honest admission that, for a great many owners, the safer, more reliable path forward wasn't trying to solve the fundamental tension between a service business built on individual talent and an owner's desire for durable, collective enterprise value. It was simply choosing not to fight that tension at all.